Chris had asked if you and I wanted to be out in the crowd, and I said, someone of your caliber and expertise and background, we can't put Jeff out in the crowd. We need to have Jeff on stage. So Jeff has been, yes, give Jeff a round of applause. So head of economics and market strategy for ClearBridge, which is the division of Franklin Templeton, which they have a significant presence here in St. Pete. So we're happy you flew down from New York, been quoted in the Wall Street Journal, have been on CNBC, CNN. So I'm excited to have you here, Jeff, because I think you've got the national perspective, but there's a lot of business owners and executives in the crowd that I think would appreciate and value the information and perspective that you have and can bring to all of us. So I'd like to start with a big picture of the U.S. economy. So it seems there's a fair amount of optimism, and I know it's a little bit, everything is controversial nowadays, but we just got the GDP print, so it came in at 2.5, little less than last year, but still pretty solid. Productivity gains are good. AI, there's a lot of hype around AI. Manufacturing accelerated in January, which is the first time in 26 months. Consumer strong, credit card spending, we got some delinquencies creeping up there. Job openings are falling, which means the labor market is, maybe slowing down. But so, I mean, if you got your crystal ball, what's in store for us for 2025?
Well, first off, really excited to be here. And we share that optimism that a lot of investors have. We think that U.S. exceptionalism from an economic perspective will continue this year because the foundational elements that have created that dynamic are still very much in place. So you hit on a couple of them. The U.S. consumer continues to be the workhorse of the economy. 70% of U.S. GDP is consumer spending, so this is a really important component. And although you are seeing an increase of delinquencies for credit cards and autos, when you peel back the onion a little bit, that's really a function of a lot of loans that were made in 2020 and 2021 when subprime borrowers had artificial credit profiles due to all of that stimulus. But if you look at delinquencies, they've rolled over and they're starting to move lower. So with household net worth up over $50 trillion, I'll say that again, $50 trillion over the last 5 years, we think that the consumer is still in a pretty good spot to continue spending. And after the election, you've seen a big boost in consumption, and we think that continues this year. So that key pillar is still in place. You continue to have fiscal and monetary support here in the U.S., and although governmental spending isn't going to be as much of a support this year versus the last couple, we still think that that will transpire to positive GDP growth this year, and we're going to get some visibility on tax cuts later in 2025, which should be a boost overall. And then monetary policy. Doesn't matter to me if the Fed doesn't cut again. They've still cut 100 basis points, which was more than was necessary to create that soft landing in 1995 and 1998. And usually, Fed cuts take about 6 to 12 months to filter through to the economy, which means we're going to start to feel that impact in the second quarter through the end of the year. So if you put that all together with some higher productivity growth, which is a really good plus, we think that the economy will be above consensus expectations, and U.S. exceptionalism will continue this year, which what we've seen over the last couple.
Okay, well, I'm feeling encouraged about that. Kind of looking at historical periods. So this is kind of an interesting time. I hear a lot of people talking about equivalents to the 1930s and 40s, and I'm a little bit of a historian myself, but all the conversation about, tariffs seems a lot more like the 30s than the 40s. But, you being the historian, what would you say the equivalent of it is for history?
Yeah, so you can never paint it with one brush, right? There's similarities from different areas. I would say the 30s and 40s, you did obviously have the Smoot-Hawley Act in the 1930s, which was one of the drivers of the Great Depression. But, there's also the inflation that actually makes a lot of sense from the 1940s. A lot of people think that the inflation that we saw was from the 70s, but if you go back to the 40s, when the war ended, people came home from the war, there was a shortage of housing, shortage of manufactured goods. You had all this pent-up demand, and inflation actually went from 1.7% in early 46 to almost 20% a year later. And then, about 2 years later, inflation was basically flat and negative to end of the decade. Right? So that kind of feels like what we had with the pandemic, right? You had this huge influx of demand. People had to buy goods because of the pandemic shutdowns. You had supply chain issues, and we had that inflation spike, and now we're back to some more normalized levels. So, there's some elements from the 40s and the 30s that we can plug in for today, but if I was to say right now where we currently sit, where do I feel like we're most similar to, it'd be the 1990s. The U.S. was strong. The rest of the world was relatively weak. Dollar was very strong during that decade. You had a transformative technology that got the equity markets moving a lot higher, and that filtered through into higher productivity growth, which was one of the key drivers of U.S. exceptionalism. So I would say this is probably like 96, 97 if I was going to make the best parallel to where we currently sit.
Okay. So you mentioned inflation. And so we've had a period of time in inflation that we really haven't seen in decades. And so we did hit, a little bit of 9% about mid-2022. It's since eased down and not maybe quite as much as the Fed liked. And if you looked at the PCE, which just came out, I mean, it's trended up since May, so kind of slowly creeping back up. Are we in for round 2 of inflation?
Well, history would suggest yes. If you looked at developed economies over the last number of centuries, about 85% of those inflation outbreaks lead to a second. But I don't think that that's going to transpire this time around, because when you break down PCE or inflation down to its 3 main buckets, there's a lot of reasons to be optimistic. So first off, you have goods inflation. Now, outside of the autos increase in pricing that you've seen because of the hurricanes in the Southeast.
Yeah, everybody's got to buy replacement cars, right?
You can buy those replacement cars, but outside of autos, you're seeing broad-based deflation in goods, which is going to be an anchor for that part of inflation looking forward. Then you have shelter inflation. This has been the stickier area of inflation, but the shelter prints that we've seen over the last 7 months on a month-over-month basis have been some of the best that we've seen in 4.5 years. So there's a lot of progress there. I think that continues. And then lastly, you have services inflation without that shelter component. Think about going out to eat, getting a haircut, going to your mechanic. Yes, that's positive, but it's nowhere near the levels that we saw over the last couple of years. So if you kind of put that mosaic together, yes, inflation is not going to be negative. It's not going to be deflationary, but it's going to continue to make progress towards the Fed's 2% target.
I do want to talk about, and it's like we kind of planned this, but we didn't really plan it. So I appreciate the flow of the conversation, but deflation. So pretty active on LinkedIn, and I post a lot of economic updates. And when the inflation reports come out, I do comment on those. And a lot of the comments I get is like, when can we get back to 2019 prices? Like, when can I get eggs for cheap? And I will respond to people, well, that's deflation. That's bad. And under normal circumstances, like, you don't want to end up in a deflationary period. And maybe there's productivity in AI that leads to lower costs, but largely deflation is not good. And as much as we would love to go back to 2019, that ship sailed. But I mean, can you kind of tell everybody why that's not a good case?
Yeah, deflation is not what we want. That means that there's no demand in the economy. There's a lot of people that are unemployed. Businesses are doing bad, so they need to cut prices. A lot of people would love lower prices, but they don't want the economic environment that goes along with it. So I think when people look at prices, they confuse price levels with inflation. Price levels are up about 22, 23% from the end of 2019. So everything's expensive when you go to the grocery store, you're trying to buy a car. But inflation, the movement of prices this year compared to last year, as you mentioned, have gone from 9.5% down to around 3% today. And we're expecting more progress on that. So I know people want lower prices, but you don't want what comes along with lower prices.
Yeah, I mean, we're not buying 5-cent coffee anymore, which is probably another good transition, because I talk about tariffs. We've had a series of 24-hour tariffs right now with like Colombia and Mexico and Canada.
Shortest tariffs ever.
Shortest tariffs ever. But like Colombia hit, and I thought like Raphael, I saw Raphael, I don't know if Sarah, but both with Kawa Coffee, and I saw Colombia, and I'm like, we're gonna have $15 lattes. Like, nobody wants a 50, like all of St. Pete's gonna be angry. But thankfully that got rolled back quick. So that said, and by the way, Raphael also told me they don't get their beans from Colombia, they get better beans. But
they have the cheapest coffee around.
cheapest, not like they go for quality. But so China, we enacted tariffs in China, and they've indicated they're going to respond. So how are tariffs going to impact us? So the last time around, there was a report, the Trump tariffs. I think the one that got all the media coverage was dishwashers.
Washing machines.
Yeah, washing machines that were up, 200%. And it seems the rest of the manufacturers kind of absorbed some of that. But is this time going to be different? How are we going to feel the impact from tariffs?
Well, it won't be different, if tariffs go into place. And again, this is a fluid situation. But back in 2018 and 2019, companies had no pricing power, right? We're in this kind of slow growth environment. The U.S. consumer was still deleveraging following the global financial crisis. So the manufacturers had to eat the cost of tariffs through their margins. We've had pricing power since the pandemic.
Right, this time's different.
It is very different. So part of that is going to get passed through to consumers. Now, it's not going to be 100%, but it's maybe 50 or 75%, depending on what industry you're talking about and what product. which should result in higher inflation, which, again, we've talked about 25% tariffs on Canada and Mexico, 10% on China. If that goes into effect, you're going to see inflation pick up by about 0.5%. It's going to slow economic activity by 75 basis points, or 0.75%. The good news is that's a one-time boost of inflation. What the Fed really concerns about is when you see inflation moving higher year after year after year, and what you need for that is stronger demand. And that's a very different dynamic than what we're talking about. But coming back to tariffs, I think it's going to be more smoke than fire on the tariffs front.
Seems like it.
Yeah, we pushed back the Mexican and Canadian tariffs for a month. You saw some progress on the immigration and the illicit drug importation fronts. I don't think that we're going to see broad-based tariffs on those trading partners, but you did mention China. China has been a target from the Trump administration from a national security perspective. I think this is the opening salvo, and we could see much higher tariffs, but it's probably going to be a lot more target specific to individual sectors that pose some national security risks. But unfortunately, from a market
chips,
perspective,
that type of thing.
chips, medical supplies, things of that nature, pharmaceuticals. So I think we're going to see China really bear the brunt of higher tariffs, but it's probably going to create some dislocations in the market as we move forward.
Immigration, you mentioned, is a hot button. So we've got 160 million workers in the country. There's an estimated 11 million illegal immigrants in the country. Half of them are employed. A lot of them are in service and construction. Assuming that everything is kind of worst case scenario, and maybe even not. I mean, just what's your opinion on how that's going to impact the labor market, agriculture?
So if you think about economic activity, there's really two things that drive it. An increase of labor force, so how many more hours are we working this year than last, and then increase of productivity. How many more widgets can I make in my factory this year versus last year with the same inputs? That's the only thing that drives GDP or economic activity. Now, one of the key tailwinds for high U.S. GDP growth has been the increase of labor force, and it's going to slow, but it's not going to go negative from a net immigration perspective. Right? If you think about the U.S., they can detain about 40,000 people at one time. It takes about a month to go through the deportation process. So 40 times 12 months, 40,000, you're looking at a run rate of about 500,000 deportations. Back in 2023, which is the latest data that we had, you deported around 200,000 people. So yes, it's an increase, but it's not nearly as bad of what people think. But ultimately, I think that net immigration is going to be positive in the U.S. this year of around 500,000 to 750,000. Put that number in perspective, net immigration was about 1 million prior to the pandemic. So you're going to see lower labor supply, but it's not going to be a net drag to the economy. But you may see some wage pressure, again, in some of the industries that you mentioned, like construction, like hospitality and leisure, that do employ a lot of illegal immigrants.
Okay, and then kind of rounding out this a little bit, but interest rates. So 30-year mortgage, if anybody has been out in the market shopping for a mortgage, 30 years somewhere between 6.6 and 6.9%, kind of depending. Obviously, if you go shorter on the yield curve, you can get a lower interest rate, but it's slowed down housing transaction volume.
Sure.
It's impacted affordability. It's been interesting enough, probably because we have a housing shortage, that it's not really impacted values yet. We had all hoped at the beginning of the year, maybe at the end of the year, that we were going to get 4 rate cuts from the Fed. Seems maybe we're lucky to get 2. But even, with the rate cut at the end of the year, like we saw rates spike. So what's your prognosis on, do we get rate cuts? Where do we end up with mortgage rates? Kind of the long-term bond? What do you see?
Yeah, so in the last 4 months since the first cut that we had in September, the markets have taken out about 3 rate cuts from the Fed. Key reason for that is you've had strong economic momentum. There's really not a reason for the Fed to cut in this environment, especially with a lot of uncertainty on the inflation picture. So if we continue to make progress on inflation, maybe we get another cut, but the market's only pricing 1.7 cuts for the rest of the year. And I would take no cuts over 1 cut if I was going to place a bet today. So I think the Fed's probably done for the next 12 months. Now, what does that mean for long-term bond yields and mortgages? It means that you're probably going to be staying at these levels this year. I don't see yields moving a lot higher from here outside of an inflation scare, but I also don't see them moving materially lower unless we get some sort of growth scare. And obviously tariffs can kind of change that picture on the magnitude and the timing of how quickly they go into effect. If tariffs go into effect immediately and they're pretty large, that's going to be pretty disruptive to the economy, and that's going to cause yields to drop because people are going to be scared. Even though inflation's moving higher, that growth is going to be much lower than anticipated. But I think that the administration is going to be much more measured if you do see larger tariffs that are going to go in over a period of years, which is really going to minimize the economic impact to companies and allow them to relocate their supply chains to jurisdictions that are a little bit more friendly. So for those of you looking for a new mortgage, I hate to say that you're probably not going to see lower mortgage rates. But the good news is I don't think that mortgage rates are going to move much higher from where we currently sit.
Well, I will just say, too, that in 1971, the interest rate was 7.7%. And so everybody was waiting on a lower interest rate. We waited 20 years until rates got back down to that level, and it was in 1992. So, like, if you're in the market to buy a house, I forget what they say, like, you know, marry the house, like rent the mortgage.
Well, and as you mentioned, supply is just not out there, right? If you look at existing home sales, they're about 4 million on an annualized run rate. Prior to the pandemic, it was like 6.5 million. So that lack of supply should keep prices resilient. You're not going to see the gains that we've seen over the last couple of years, but you should still continue to see house price appreciation.
And I would add in this market, I mean, we lost a lot of supply with the hurricane, so that's probably a little bit more aggravated in this particular area. But I want to close out by talking about the national debt. So there's a lot of conversation around DOGE and reducing, our expenditures. I will also say that, it seems like there's a lack of buyers on the Treasury, which is also kind of forcing up interest rates a little bit. I don't know if that's related to our national debt, but a couple stats I thought were interesting for all of you. National debt is $36.4 trillion, which is 125% of debt to GDP ratio. It's been up 80% since the pandemic. We're running a $2 trillion annual deficit, paying $1 trillion in annual debt service. Our national budget annually is $5 trillion, so 20% of our annual spend is now on debt service. Like, when does it become too much, and when does it become an issue? And I kind of see it as one of the biggest threats to the economy, if not national security.
Yeah, so I'll talk about DOGE first. I know there's a lot of excitement about how much the DOGE can do, but realistically, about 60% of our budget is going to Social Security and Medicare.
It's such a small portion, right?
It's a small portion.
Well, I would also add, like, if you're a politician, and I know we have some politicians in the crowd, nobody wants to cut services. So, it's kind of antithetical to what, like, they do. You don't want to be the person who cuts services, right?
Well, that's a fast way not to get reelected.
Right.
So
yeah.
that's third rail. Then, as you mentioned, about $1 trillion in debt service costs. So what's left over? About $2 trillion in discretionary spending, half of which is going to the military. So you got $1 trillion that you have to work from to be able to cut costs. So I would think the DOGE is successful if we get to $300 billion in cost savings, maybe $400 billion, but getting more than that will have to touch some of these areas that are likely not going to be viable. As far as the debt is concerned, look, the debt levels have screamed higher, but believe it or not, debt to GDP levels have dropped since the beginning of the pandemic. They went to 133% at its peak, and they've dropped about 10 percentage points over the course of the last 4 years. So overall debt levels are not as bad as what they seem, but at a 6% budget deficit of GDP right now on an annual basis, you don't see that outside of wars and global financial crises. This is uncharted territory. So we do need to get our fiscal house in order, but looking at our debt to GDP, Japan has double the debt to GDP that we do, and they have some of the lowest borrowing costs in the world, right? So there's some runway for us to accumulate debt. And we have the world's reserve currency with the dollar. No other country can supplant the dollar. It's not the Chinese yuan. That's a managed currency.
What about BRICS?
The BRICS?
Yeah, the BRICS.
The BRICS, I mean, they all have their own currency, but I mean, it's nothing that's going to be as
It's going
deep
to challenge the dollar.
as liquid as the dollar. So because of that exorbitant privilege, I hate to say it, but we can run debt levels higher for a long period of time. And if we do have any issues with the debt, we're talking 10 or 15 years from now.
All right. Well, Jeff, appreciate you joining us today. So thank you.
Thank you for having me.
This is a treat, everybody. Thank you, Jeff. Thanks, man.